Hey guys, welcome to the series Building Your Real Estate Empire, Cash Flow and the 36 Other Financial Metrics. Now, this is the introduction. Let's first start off with mastering the 4 ways to prosper in real estate. Whether you're a seasoned income property investor or just stepping into the world of real estate investment for the first time, this comprehensive guide will equip you with the tools to run the numbers on any real estate venture. Designed as an indispensable reference, this book aims to empower you with a profound understanding of the essential metrics, rates of return, cash flows, estimates of value, amongst others. By delving into financial fundamental calculations, you will emerge as a shrewder and more informed investor, capable of making sound decisions and maximizing your potential on any income property. Without a grasp of these key formulas, evaluating the profitability of a property becomes nothing more than guessing game. Don't be fooled by the superficial, impressive rental income. This book will teach you to discern the hidden truths using practical rules of thumb, preventing you from falling into the trap of investing in losing properties. The topics covered in this handbook encompasses crucial aspects of real estate investment, offering you a well-rounded approach to building a portfolio. 1. Estimating current and future property value. Understanding how to assess the present and future worth of a property is vital for making informed investment choices. This book will guide you through the process of accurate valuation, ensuring that you can ascertain a property's true potential. Number 2, reading between the lines of property sellers. Negotiating with sellers requires finesse and insight. Learn how to decipher the nuances of sellers' information, allowing you to identify advantageous deals and negotiations with confidence. 3. Forecasting revenue streams, expenses, and net operating income. Anticipating the Anticipating the financial performance of an income property before purchasing is crucial. Unravel the intricacies of forecasting revenue streams, expenses, and net operating income to make well informed investment decisions. The time value of money concept for long term success. Long term investments necessitate an understanding of the time value money concept. Uncover its significance and learn how to wield it effectively to enhance your investment strategy. 5. Comparing investment opportunities. Not all investment opportunities are created equal. Develop the ability to compare different returns objectively, considering their risk and return profiles to identify the most promising opportunities. 6. Calculating financing, rates of return, and tax liability. Delve into the intricacies of financing options, determining rates of return, and understanding potential tax implications. This knowledge will empower you to optimize your investment decisions and maximize profitability. As you embark on this enlightening journey into this world of real estate investing, remember the crucial rule of thumb: emotions should never drive your investment choices. Avoid falling in love with a property or holding on it due to sentimental attachment. Successful investors prioritize financial measures, focusing on the income streams and return on investment. Just as a skill builder lays a strong foundation for a new structure, we will begin by exploring the bedrock of real estate investing: the 4 basic returns. These returns form the core of nearly every calculation and concept we will explore throughout the book. Mastering these 4 elements is the key to success in the dynamic world of real estate investing. Without further ado, let's delve into the heart of real estate investing: the 4 basic investment returns. Each income property investment presents the potential for these return in varying proportions, and understanding the dynamics will guide your investment decision in alignment with your goals. From this point forward, every concept and calculation we discuss will be intricately connected to these fundamental returns, unlocking the secrets to prospering in the realm of real estate investment. Now, understanding what successful investors truly seek. When it comes to successful real estate investors, their preference regarding property characteristics might vary widely. Some may gravitate towards properties in perfect conditions, while others might be drawn to those that require substantial work and renovations. Similarly, the choice between residential or commercial, city or suburban, brick or frame, and even color of the property might be influenced by the personal comfort and individual taste. However, there is a critical distinction that sets accomplished investors apart. They are focused on the property's anticipated economic benefits rather than its physical attributes. For them, the income streams take precedence over all these. A fundamental rule of thumb in the realm of real estate investment is to refrain from making investment decisions based on emotional factors. Succumbing to the allure of building merely due to emotional attachment can lead to poor investment choices. Similarly, holding on to a property due to sentimental reasons when selling would be more prudent can be detrimental to the investor's financial success. Investors are advised not to let emotions govern their decisions. Instead, they should be guided by sound financial reasoning. In essence, a successful investor approaches real estate as a vehicle for generating returns on their investment. The primary focus is evaluating the numbers meticulously, analyzing current financial data, and making reasonable projections for the future performance. The preceding rule of thumb reinforces the idea that sentimental attachment to a property should never drive an investment decision. Instead, the cornerstone of each decision should be the property's income stream and the potential return on investment it represents. To illustrate this point further, let's explore the significance of the property's attributes surrounding in relation to income stream. While the physical characteristics and location of a property do play its role in its overall performance, they are secondary to the potential economic benefits it can offer. For instance, the arrival of a major new employer in the area may increase the demand for apartments, making it an opportune time to explore investments in apartment buildings. Similarly, the prospect of increased rents might outweigh the cost of rehabilitating a property, making it a fixer-upper and potentially lucrative choice. For a prudent investor seeking a successful return on the investment, diligent evaluation of the numbers is imperative. This involves considering the current financial data and making reasonable projections of the property's future performance. Sentimental attachments to a property should never sway these evaluations. The journey to becoming a seven investment real estate investor starts with a strong foundation. Just like constructing a new building, understanding the four basic investment returns is crucial in this process. These returns, cash flow appreciation, loan amortization, and tax shelter, form the bedrock of a real estate investment. As you delve deeper into the concepts and calculations that follow, keep these four investment returns at the forefront of your decision making process. They will guide you towards making an astute and successful real estate investment, ensuring your financial prosperity in the realm of income properties. Generating wealth in real estate, understanding the four basic investment returns. In the world of income property investment, there are four crucial elements that lie in the heart of every real estate venture to varying degrees. These elements represent fundamental ways to make money with income property, and we refer to them as the four basic returns. 1. Cash flow. 2. Appreciation. 3. Loan amortization. 4. Tax shelter. It's important to acknowledge that not every income property investment will yield these returns in equal measure. Each property assesses its own unique blend of these benefits, and some investments may even lag on one or more of these returns altogether. For instance, while one property may generate substantial annual cash flow, another might offer minimal cash flow but the promise of significant gains upon sale. Nevertheless, when combined, these four returns constitute the comprehensive pool of potential benefits that real estate investors investing can provide. When making investment decisions, it's crucial to consider your personal goals and evaluate the strengths of these returns. Understanding their origin and how to calculate them will set you on the path to success. Throughout this book, nearly every concept and calculation we will discuss will be linked to these four essential returns. Cash flow, the essence of funds. Cash flow is akin to managing a checkbook. Money comes in, money goes out. The essence lies in the flow of funds, and this precisely why it's referred to as cash flow. During a specific period, usually a year, the key concern is whether more money comes in than more money goes out. If at the end of this period you have taken in more money than you've spent, you've achieved a positive cash flow or spendable cash. This implies that there is money left over after settling all the expenses and it becomes a source of income for you as an investor. On the other hand, if you've spent more than you've earned, resulting in deficit, you've incurred a negative cash flow. This negative cash flow represents a deficiency that requires attention and resolution. Just as nature abhors a vacuum, a negative cash flow demands immediate action, prompting you to fill the gap from external funds such as your savings. It is essential to recognize the significance of making accurate financial projections, as a negative cash flow could indicate that the property lacks sufficient cover to cover its expenses. In such cases, the investor must allocate personal resources to cover the deficit. But thoroughly understanding and anticipating cash flow, you can make a well informed investment decision. Rule of thumb: project and calculate wisely. Project and calculate wisely. For small investors, a negative cash flow is not merely an accounting entry. It signifies that at a specific point in time, the property may not have enough cash to meet its financial obligations. As a result, you, as an investor, may need to contribute personal funds to make up the shortfall. However, the presence of occasional negative cash flow does not necessarily render the investment fatally flawed. You may recoup such losses throughout other returns or in subsequent years. This emphasizes the importance of making accurate projections and diligently evaluating the overall investment. By doing so, you can anticipate negative cash flow scenarios and address them proactively. Failure to conduct such projections may lead to unforeseen financial challenges. Here's an example in understanding cash flow. Let's explore as an example of cash flow from an income property. Suppose you own a 6-unit apartment building with 2 units rented out at 800 Rand per month, 2 at 900 and 1 and 2 at 1000. All units are occupied and the tenants consistently pay you on time. Your monthly mortgage payment is 2,800 Rand, and over the past year you've incurred expenses as follows: 14,100 for real estate taxes, 3,800 for property insurance, 4,200 on maintenance and repairs, and 800 Rand for water, 75 Rand for miscellaneous supplies. Now, here's the calculation. Cash in, you have 2 800 Rand properties, 2 900 Rand properties, 2 1,000 Rand properties, which gives you a total of 5,400 Rand per month total cash flows. And now, over the 12 months, that's 64,000 Rand a year. Now, here's the cash out calculations. Mortgage is 2,800 Rand times 12 months. Property taxes 14,000. Property insurance 3,000. Maintenance and repairs 2,000. Water 800. Total outflows 53,400. Total cash out 11,400. After evaluating your cash flows, cash inflows and outflows, you find that you've taken in more than you've spent, resulting in a positive cash flow. The specific source of these inflows and outflows is less relevant. What matters is the overall flow of funds. Inflows may originate from rent, loan proceeds, vending machines revenue, or any other property related source. Likewise, outflows may include operating expenses, debt reduction, expenses associated with ending more rental units. Understanding and accurately calculating cash flows allows you to gauge the financial health of your investment and determine its potential for providing a steady stream of income. Understanding appreciation and loan amortization. Let's first start with appreciation. In the world of real estate, investing in cash flow from a property is always desirable as it means a steady stream of spendable income each year. However, not all properties generate significant cash flow. For those that don't, the next essential aspect to consider among the four basic returns is appreciation. Appreciation refers to the growth in value that the property experiences over time. The formula for calculating appreciation is very straightforward. Future resale price minus the original purchase price is equal to appreciation. To better understand the concept of appreciation, think of it in similar to growth of funds in savings account. When you deposit 1 Rand into account today, the interest over time causes that amount to increase. Naturally, you might wonder, how much growth in value can I expect and over what period? Answering these questions might require a deep understanding of what drives property appreciation. While this book delves into the topic in more detail, a fundamental principle is that the value of an income property is closely tied to its revenue, especially net revenue, after accounting for operating expenses. Essentially, real estate investors are buying the income stream that the property generates. The more substantial the income stream, the higher the property's value is likely to be. Various factors can contribute to increasing revenue and subsequently property appreciation. Changes in market conditions can make a property more attractive, turning a previously marginal area into a fashionable one, leading to a shift in supply and demand. General economic inflation can raise the cost of new construction, resulting in upward pressure of rents. Appreciation can be influenced by actions taken by the property owner, such as making physical improvements that allow for higher rental rates, implementing better management practices to attract and retain quality tenants, reducing vacancy losses, and minimizing wasteful expenditures. Though you won't fully enjoy the benefits of appreciation until you decide to sell the property, when you do, the value gained from appreciation can be substantial. However, it's crucial to note that this is not a get rich quick, but rather a long term wealth building strategy. Now, for example, calculating appreciation. Suppose you purchase a property for 1 million Rand and sell it at a future date for 1.4 million Rand. The amount of appreciation is 1.4 million minus 1 million is 450,000 Rand. That's the loan amount. That's the appreciation. Now, loan amortization. One of the joys of using a mortgage loan to buy an income property. One of the joys of using mortgage loan to buy an income property is that it allows somebody else to pay your bills. For instance, consider a 1 million rand office building. Instead of paying the full amount upfront, you could write a check for 300,000 rand and secure a loan for 700,000 rand. This leaves you with extra capital, enabling you to consider additional investments. A mortgage loan, however, comes with regular payments, usually made on a monthly basis. So where does the money come from to make these payments? This is where the cash flow concept comes into play. As we previously explored, rental revenue constitutes a significant portion of cash inflows, and it is these rental payments that effectively pay down the mortgage debt. Every mortgage payment includes both interest and principal, though the exact amount of each can be calculated in more detail. For now, let's focus on the concept. Your tenants' rent payments essentially help you to buy property by chipping away at the mortgage debt over time. The process of gradually paying off debt through regular installment payments is known as amortization. For Latin scholars, amortization can be thought of as add towards mort, death, which refers to the killing off of the loan. The debt service, this is the total mortgage payment minus the interest paid. That's the amortization. Income property data is often evaluated on an annual basis, giving rise to the term annual debt service, which represents the total payments made in a year towards mortgage. For example, calculating loan amortization. Suppose you make monthly payment of 1,500 Rand. At the end of the year, your bank informs you that you have paid 15,000 in interest towards the year. To determine the loan amortization for the year, apply the formula. ADS 1,500 Rand times 12 is 18,000 Rand. Now remember, appreciating your fundamentals of appreciation and loan amortization can significantly enhance your understanding of real estate investment and contribute to making informed decisions for long term financial growth. Annual debt service minus the interest paid for the year is 15,000 times 12 minus the 15,000, which is 3,000 Rand. Now for the tax shelter. Did you know that you can significantly increase your tax liability through property investments in South Africa? It's all thanks. It's all thanks to sections 13 SEX of the SA income tax, one of the biggest income tax available to property investors. With sections 13 SEX, qualifying property investments have the opportunity to claim up to 55% of the property price of an apartment or property over 20 years. This incredible benefit has profound impact on your portfolio's return on investment, allowing you to be in cash flow positive and profitable situations without owing SARS a single cent. The mechanics of these incentives are straightforward for the purpose of calculating the deduction. The cost of acquiring a residential unit is considered to be 55% of the purchase price. To qualify, you must own at least 5 residential units in South Africa solely used for the purpose of your trade and acquired on or after 21 October 2008. 5% deduction per annum over 20 years applies only to new and unused units. If you're building if you're building your property portfolio or already own 5 or more properties, take advantage of this opportunity by completing the questionnaire you can arrange with a consultant. And anyway, moving on. SARS might be known for giving money back, but little known fact is that they have a tax incentive called Section SEX under the Income Tax Act 58 of 1962. This incentive is specifically designed to offer a significant tax benefit to purchases of residential units. Now, how does this section work? When you purchase rental units after 21 October 2008, you're entitled to write off a percentage of the cost of the buildings. SARS aims to incentivize property investment for accommodation purposes by offering investors a percentage of the purchase price back. To qualify for this incentive, certain requirements must be met. You must own at least 5 residential units acquired either together or over time. All 5 units must be used for rental purposes, not occupied by you or your family. 5 properties must be located in South Africa, available only to South African taxpayers. The units must be new and unused, with tenants placing by the owner or rental agent. All 5 properties must be owned by one person with a single tax number. There are 2 property types to consider for this incentive. A. Sectional title. You own the property inside the walls and usually applicable to flats apartments. SARS offers a 55% reduction on the purchase price over 20 years. B. A full title. You own both the building and the land. Here, taxpayers can claim up to 80% of the building cost over 20 years, as the land does not depreciate. It's essential to note that selling a property before the 20-year claiming period Expiration triggers normal recoupment provisions, and the provisional tax advisor can assist with calculations. The sales incentive acts as a deduction on your personal income tax or your property's company's income tax. With that being said, please consult with a tax consultant before you start with your property journey. Here's an explanation, short explanation from SARS. We'll link to that under the video. Now, in summary, congratulations. Now that you have a solid foundation, you understand the four key returns that every income property can offer: cash flow, appreciation, loan amortization, and tax shelter. Cash flow is a surplus money after all expenses. Appreciation is the increase in the property value. Amortization reflects the equity growth through mortgage paydown, and tax shelter yields income from taxation. With this knowledge, you're well equipped to dive into the world of real estate investing. From this point forward, every concept and calculation we'll explore will revolve around these fundamental returns. Get ready to take your real estate investment journey to the next level. Anyway, see you in the next video. Bye.